What if the biggest success story in modern economics isn't innovation, productivity, or trade? What if it's debt? Look around. Households are in debt. Corporations are in debt. Governments are in debt. Entire continents operate under debt. It expands. It expands. Here's the mystery. Here's the mystery. If debt is supposed to be a burden, why does the global economy seem to depend on it? Why does growth accelerate when borrowing rises, and panic begin when borrowing slows? Somewhere along the way, we stopped asking whether debt was a tool and started accepting it as oxygen. Tonight, we're going to trace how an economic model emerged, quietly, gradually, that doesn't just tolerate borrowing, it profits from it. Act I Origins. When money changed its nature, to understand perpetual borrowing, we need to go back. Before modern banking, money was mostly tied to physical assets, gold, silver, or tangible reserves. Lending existed, but it was limited by what physically existed. Then something changed. In 1694, the Bank of England was created. It wasn't just another bank. It pioneered a model. Governments could borrow large sums from private financiers in exchange for issuing interest-bearing bonds. This was revolutionary. Instead of raising taxes first and spending later, governments could spend immediately and promise repayment over time. Debt became a bridge between present ambition and future revenue. For centuries, borrowing funded wars, infrastructure, and expansion, but it was still relatively constrained. Then came a structural shift. In the 20th century, especially after the collapse of the gold standard and later the 1971 decision by the Federal Reserve under Richard Nixon to end dollar convertibility to gold, money became fully detached from hard assets. Currency was no longer tied to something finite, and it became tied to trust and debt. This is where the real transformation began. Act 2. The Rise. How credit became the engine. Here's the critical mechanism. Modern banks operate under fractional reserve principles. They don't lend out existing money, they create deposits when they issue loans. When you take a mortgage, the bank doesn't transfer someone else's savings to you. It creates a new deposit in your account. Money is created the moment debt is issued. Think about what that means. If loans create money, and money is required for economic activity, then debt becomes necessary for growth. Now scale this logic. Governments issue bonds to fund deficits. Central banks buy those bonds, injecting liquidity into the system. Corporations issue debt to buy back shares and boost valuations. Consumers borrow to maintain lifestyles as wages stagnate. Every level of the economy becomes synchronized around expanding credit. And here's the twist. Interest compounds. If total debt grows at a certain rate, interest payments grow faster unless new borrowing continues. That creates structural pressure. The system doesn't just allow borrowing. It requires continuous expansion to remain stable. Act 3. The breaking points. This model has hit walls before. In 1929, excessive leverage helped fuel the crash that triggered the Great Depression. After years of speculation, fueled by borrowed money, asset prices collapsed, borrowing stopped, money supply contracted, economic oxygen disappeared. And again in 2008. Leading up to the financial crisis, banks aggressively expanded mortgage lending. Complex securities magnified exposure. Housing prices rose because credit expanded. But once defaults began, lending froze. And when lending froze, the system nearly collapsed. Governments responded by increasing borrowing. Central banks slashed rates and injected trillions in liquidity. The Federal Reserve expanded its balance sheet dramatically. Why? Because in a system where money equals debt, contraction of debt equals contraction of money. That's the hidden vulnerability. Borrowing slows significantly. The entire structure destabilizes. Act 4. Fallout. The new normal of permanent stimulus after 2008. Something unprecedented happened. Interest rates were pushed to historic lows, near zero. Quantitative easing became standard policy. Central banks bought government bonds at massive scale. Debt didn't shrink, it exploded. Global debt surpassed global GDP. Corporations refinanced endlessly. Governments ran persistent deficits. Asset markets soared, stocks, real estate, bonds, but wage growth lagged. Here's the paradox. The more debt expanded, the more asset owners benefited. Rising stock markets enriched investors. Rising housing prices enriched property holders. Those without assets faced rising costs. This model doesn't distribute evenly. It rewards leverage, and it penalizes restraint. Act V failed fixes. You might assume policymakers tried to exit this cycle. They did. After the 2008 crisis, there were attempts to normalize interest rates. But every time rates rose meaningfully, markets reacted violently. In 2018, modest rate hikes triggered sharp market declines. In 2022 to 2023, aggressive rate increases to fight inflation strained banks and debt markets. Why? Because when debt levels are high, even small increases in interest costs ripple outward. The higher the total leverage, the more fragile the system becomes to tightening. The model has evolved into a trap. Much borrowing creates instability, but stopping borrowing creates collapse. So the default choice becomes continue expanding. Modern parallels the pattern repeats. Look at the data. Global debt now exceeds $300 trillion. Sovereign debt levels in many advanced economies sit near or above 100% of GDP. Corporate leverage remains elevated. Household debt continues climbing in many regions. Each crisis minus 2008-2020 pandemic, regional banking stress is met with larger stimulus than the last. The pattern repeats. Expansion fueled by credit, asset inflation, shock, massive intervention, even larger debt baseline. The system resets, but at a higher level of total obligation. We're no longer in a cycle of borrowing. We're in a staircase of cumulative leverage. And here's the deeper truth. Perpetual borrowing benefits specific actors. Governments maintain spending power without immediate taxation. Financial institutions earn interest and fees. Asset markets inflate, rewarding those already invested. The cost? Future taxpayers, currency dilution, reduced purchasing power. Inflation, in many cases, becomes a silent method of managing excessive debt, eroding real value over time. The core insight, it's not accidental. This isn't necessarily a secret conspiracy. It's structural. When money is created through lending, and interest must be repaid with money that only exists if more lending occurs, expansion becomes embedded. It's mathematical. The model stabilizes itself through growth or destabilizes through contraction. So policymakers choose growth, even when it increases fragility. 3 takeaways. 1. Debt is not just a byproduct, it's the foundation. Modern money systems are intertwined with credit creation. Understanding this changes how you interpret recessions, stimulus, and inflation. 2. Stability often requires more borrowing, not less. In highly leveraged systems, reducing debt too quickly can cause cascading collapse. That's why interventions grow larger over time. 3. Asset ownership is strategic in a debt-driven model. When liquidity expands, assets typically inflate. Those positioned in real assets or productive investments tend to benefit more than those holding idle cash. A warning and an open question. History shows that economic models based on continuous expansion eventually confront limits demographic, political, or inflationary. The question isn't whether perpetual borrowing can continue indefinitely. The question is, what happens when growth slows while obligations remain? Will inflation absorb it? Will restructuring occur? Or will a new monetary architecture emerge? The system that profits from perpetual borrowing has reshaped economies, incentives, and wealth distribution for decades. But no model is permanent. Understanding its mechanics may be the difference between reacting late or positioning early. If you found this breakdown valuable, subscribe for deeper explorations into the hidden architecture of modern finance. Because the more you understand the system, the less likely you are to be controlled by it.